Welcome back to the Deep Dive. It is Thursday, January 29, 2026. Today, we are taking a look at a company that's so embedded in our cultural consciousness
Yeah.
that it's almost become invisible. Or maybe, more accurately, it's become a symbol.
You're talking about Nasdaq.
I am. And be honest, when I say NASDAQ, what is the first image that pops into your head?
Oh, it's got to be the big video wall,
Yeah.
in Times Square. Or maybe the opening bell ceremony.
Hell, yeah.
People clapping, confetti, that scrolling ticker tape at the bottom of the TV screen.
Exactly. That is the image we all have. It's the place where stocks live. But, and here is the hook for today's deep dive. If you think NASDAQ is just a place where people shout buy and sell, you are looking at a picture from 10 years ago.
Oh, easily.
We're looking at their Q4 and full year 2025 earnings report, which just dropped this morning, and it reveals a massive identity shift.
It really does. I've been going through the press release, the slide deck, and the full transcript of the earnings call with CEO Adina Friedman. And you're right to call it an identity shift. This is not just an exchange anymore.
So, the mission here is to prove to you that NASDAQ has quietly transformed into a massive financial technology platform. We're going to talk about how they're using something called agentic AI to fight financial crime, and their very real plans to keep the stock market open 23 hours a day.
It's basically becoming the operating system for the global economy, and we have the source material right here to back that up.
Okay, let's get into it. The most fascinating thing about this earnings report isn't the total profit,
Although that's important.
of course, but it's the source of that profit.
All right, it's the mix, and that signals a fundamental change in how the financial system actually works.
Let's start with that big pivot. Give us the headline numbers for 2025, just so we can get grounded.
So, high level, 2025 was a record year for them. Net revenue hit $5.2 billion. That's a 12 to 13% increase year over year.
Pretty solid growth.
And if you look at their profitability, their GAAP earnings per share is up 60%. So financially, the company is incredibly healthy.
Okay, so they made $5.2 billion. But this is where that aha moment comes in.
Yeah.
You pointed out something in the revenue breakdown that I think will surprise a lot of people.
Yes. So they break their revenue down into different buckets. Now, historically, you'd expect the biggest bucket to be market services, trading fees, transaction fees.
Right, the stuff that happens when you buy a share of Tesla. The exchange part of the exchange.
Exactly. But look at this other bucket called solutions.
Yeah.
This includes their financial technology, their data services, their indices, and their anti-financial crime software. For the first time ever, solutions revenue hit $4 billion.
$4 billion.
And to put that in stark context, that is 76% of their total net revenue.
Wait, just let me pause there. 76%. So you're telling me 3/4 of NASDAQ's money has absolutely nothing to do with me buying or selling a stock on my phone.
Precisely, and that is the massive pivot. Think about it from an investor's perspective. An exchange business is traditionally very volatile. If the market crashes or if people get scared and stop trading, volume dries up. Your revenue dips. It's a roller coaster.
You're at the mercy of the market mood.
But solutions, that is largely recurring revenue. They finished the year with an annualized recurring revenue, or ARR, of $3.1 billion. That's up 10%.
Recurring revenue is the magic word on Wall Street, isn't it?
It is. It's the subscription model. Think of it like the difference between a movie theater and Netflix. A theater needs you to decide to leave your house and buy a ticket every Friday night. Netflix gets paid every month whether you watch a movie or not.
And NASDAQ has become the Netflix of financial infrastructure.
They're effectively a SaaS company, software as a service, that just happens to own a stock exchange on the side.
That is a huge distinction. It changes how you value the company completely. It's less of a casino floor and more of a cloud computing platform.
Exactly. And on the call, the leadership team kept mentioning these three strategic pillars: integrate, innovate, and accelerate. Now, usually I kind of gloss over corporate slogans, but innovate is actually doing a lot of heavy lifting here.
It is. And that brings us to the part of the report that felt the most sci-fi to me. The financial technology division. It grew 11% overall, but inside that division, there's a specific sector called financial crime management.
This is primarily the Verifin business they acquired a few years back.
Right. And in Q4, that specific segment grew 24%. That is massive growth for a company this size. But it's how they're growing that stopped me in my tracks. They introduced something called the agentic AI workforce.
Yes. This is where we have to be careful with our terms because AI is a buzzword that gets thrown around for, well, everything.
Right. Usually just means a slightly smarter spell check.
Exactly. But agentic is different. The key word is agent. It implies agency, the ability to act independently. A standard chatbot is passive. You ask it a question, it gives an answer. An agentic AI is designed to perform a complex workflow from start to finish. It doesn't just talk, it does.
Okay, can you give me a concrete example from the report? What is one of these agents actually doing day to day?
So at the end of Q3, they launched the Agentic Sanctions Analyst. Now imagine you are a major global bank. You process millions of transactions every single day. You are legally required to check every single one to make sure you aren't accidentally sending money to a sanctioned entity, a terrorist organization, or a drug cartel.
And I assume usually an automated system flags anything suspicious, and then a human has to go look at it.
Exactly. And the problem is false positives. The system flags everyone named John Smith because there's one bad John Smith on a list somewhere. A human analyst has to open the file, check birth dates, check locations, look at history, and write a report saying, this is the wrong John Smith, clear the transaction. It's tedious, high-stakes police work. Causes massive burnout.
So Nasdaq's AI agent now does that.
It automates that entire workflow. It investigates the alert, gathers external data, makes a determination, and documents the reason for the audit trail. And just this month, January 2026, they launched another one called the Agentic Enhanced Due Diligence Analyst.
So it really is like RoboCop for banking compliance. It's an autonomous worker.
In a way, yes. And the banks are absolutely loving it. Adina Friedman mentioned on the call that client reception has been enthusiastic. But here is the stat that blew my mind. They have now signed every single GSIB as a client.
GSIB. Okay, for the listener who might not know that acronym, break it down.
Global Systemically Important Bank. These are the too big to fail banks. JP Morgan, Citi, HSBC, Deutsche Bank. Every single one of the world's most critical financial institutions is now using Nasdaq's tech to help manage risk or fight crime.
That is wild. It's like a total monopoly on the police work of the financial system.
And they are deepening that moat. They just announced a partnership with a company called BioCatch to add behavioral intelligence to this. So now they aren't just looking at the transaction data, they're looking at how a user types, how they move their mouse, to detect if it's a fraudster or the real customer.
That is incredibly sophisticated. So, stepping back, they aren't just listing stocks, they're acting as the immune system for the global economy.
That is a perfect analogy.
Okay, so they're a tech giant. They're the robo-police. But we can't ignore the legacy business completely, right? They still run the Nasdaq stock market.
Yeah.
Are they still winning there, or is that taking a back seat to the software sales?
Oh, they are definitely still winning. In fact, interestingly enough, even as they pivot to tech, they are absolutely dominating the traditional exchange game. You see this most clearly in the switches.
Switches, you mean companies leaving the New York Stock Exchange to join Nasdaq?
Right. It's a fierce battle. And in 2025, a record $1.2 trillion in market cap switched to Nasdaq.
1.2 trillion with a T. That sounds like a lot of money moving across the street.
It's historic. And the crown jewel of that migration was Walmart.
See, that surprises me. Walmart feels like the ultimate old-school brick-and-mortar blue-chip stock. That feels like it belongs on the NYSE with the guys in the funny jackets. Why go to the tech exchange?
It's fascinating, isn't it? It was the largest exchange switch ever completed. And it wasn't just them. Shopify, Kimberly-Clark, Thomson Reuters. These are massive established names.
So why do they do it? Is it just cheaper fees or something?
Cost is a factor, sure, but at the scale of Walmart, listing fees are a rounding error. On the call, management talked about the liquidity and the technology platform. Nasdaq's matching engine is incredibly fast. But honestly, there is a huge branding element. Even for a company like Walmart, you want to be associated with growth, with technology, with the future. Nasdaq owns that brand narrative.
That makes sense. You want to be listed next to Apple, NVIDIA, and Microsoft. You don't want to be listed next to some utility company from 1920.
Exactly. It sends a signal to investors about who you think you are. Plus, look at the IPOs. Nasdaq secured 3 of the top 5 IPOs in 2025, including Medline, which was the biggest IPO of the year.
And Verisure, right, the biggest one in Europe.
Correct. They also have this new methodology for calculating their win rate for listings, and under that new math, they are winning 72% of eligible companies. So while they're building this massive software business, they're essentially vacuuming up the biggest listings in the world simultaneously.
It's that one Nasdaq strategy they keep mentioning. They get you on the exchange, then they sell you the software, then they sell you the investor relations tools.
It's a flywheel, a very profitable flywheel.
Now, speaking of the future, there was something in the report that made me check the date to make sure I wasn't reading a sci-fi novel. They are talking about changing the definition of market hours.
Ah, yes. The 23 by 5 initiative.
23 by 5, meaning trading 23 hours a day, 5 days a week.
That is the plan. They announced they're targeting the second half of 2026 for this launch, obviously subject to regulatory approval.
I have to play devil's advocate here. Why? Who needs to trade a stock at 3:00 a.m. on a Tuesday? Is this just for insomniacs and degenerates?
It sounds extreme, I know. But the demand isn't coming from day traders in their pajamas. It's coming from institutions. You have to remember, the world isn't asleep when New York is. There's huge demand from global investors, particularly in Asia, who want to manage their risk in real time.
Okay, give me a scenario. Why does a fund in Tokyo care about trading a U.S. stock at their lunchtime?
Okay, imagine you're a massive pension fund in Tokyo. It's 2:000 p.m. for you, but 2:00 a.m. in New York. Suddenly, breaking news hits that affects the U.S. tech sector, maybe a supply chain collapse or a regulatory ruling. If the market is closed, you are stuck holding that risk for 7 or 8 hours until the opening bell rings in New York. In that time, you could lose millions.
I see. So they want the ability to hedge that risk immediately, regardless of what time it is in Manhattan.
Exactly. If the news cycle is 247, the risk management cycle has to be 247 too.
But that changes the ritual of the market, doesn't it? The opening bell becomes a little symbolic if the market has already been open for 20 hours.
It does change the culture. But more importantly, it changes the infrastructure. If you're trading 23 hours a day, you have a settlement problem.
Right, because typically trades take a day to settle for the money and stocks to actually change hands.
Correct. T+1 settlement is the standard now. But if you are trading continuously, you need better ways to move collateral and settle trades faster. Which leads us to the other futuristic buzzword in the report, tokenization.
I saw that. And I have to ask, because every time I hear tokenization, I think of crypto scams and pictures of bored monkeys. Is Nasdaq getting into crypto?
It's the obvious question, and one that actually came up in the Q&A. Adina Friedman was very clear about this. This isn't about crypto-native anarchy or listing meme coins. They filed for tokenized securities.
Okay, distinguish that for us. What's the difference between a tokenized security and a crypto coin?
The difference is integration and regulation. They aren't trying to build a separate casino on a blockchain. They want to integrate tokenization into the existing regulated infrastructure, like the DTCC, the Depository Trust and Clearing Corporation.
So they're using the technology of blockchain, the distributed ledger, but applying it to boring, regulated stocks.
Yes. The goal isn't speculation, it's capital efficiency.
Capital efficiency. That's a bit of jargon. Break it down for us.
It just means money moves faster. If markets are open 23 hours a day, you can't wait a day for a trade to settle or for collateral to move between banks. Tokenization allows that value to transfer almost instantly via smart contracts. It reduces the amount of idle cash just sitting around.
So it's upgrading the plumbing. It's replacing lead pipes with fiber optics.
Exactly. And doing it with issuer choice and investor protection. Friedman emphasized those phrases. They want to bring the speed of crypto to the safety of the regulated market.
That makes sense. It's less to the moon and more, let's make the pipes flow faster so the 23-hour market doesn't break.
Precisely. They also mentioned exploring event options, contracts based on specific outcomes, but again, doing it in a regulated way, unlike some of the wild prediction markets we see popping up online.
Before we wrap up, we have to touch on the financials again. Because pivoting a company like this, buying Verafin, building AI agents, launching 24-hour trading, that costs a fortune. Is Nasdaq actually stable enough to afford all this?
They're surprisingly disciplined. If you look at their balance sheet, they've been paying down debt aggressively. They reduced their gross leverage to 2.9x.
And they had a target of 3.0x, right? So they beat their own goal.
They did. And remember, they took on massive debt to make those big software acquisitions. So paying it down this fast shows strong cash flow. Speaking of which, they generated about $2.2 billion in free cash flow. That is a lot of dry powder.
There was a stat that caught my eye. They're converting 109% of their net income into free cash flow. How is that mathematically possible? How do you have more cash than profit?
It's a great sign for a software business. It usually means they have significant non-cash expenses like depreciation and amortization of intangible assets. These are accounting costs that lower the net income number on paper, but they don't actually involve writing a check. So the cash register is ringing louder than the accounting profit shows. It's a sign of a very efficient cash-generating machine.
And the credit rating agencies noticed.
They did. Both Moody's and S&P upgraded their debt ratings. And they're sharing the wealth. They bought back $286 million worth of shares just in Q4 and paid out dividends.
So they aren't just burning cash on science projects. They are profitable, they are efficient, they surpass their efficiency targets with over $160 million in cost reductions, and they're investing in this high-tech future simultaneously.
It's a rare combination of growth and discipline. Usually you get one or the other.
So to bring this all together, we started this deep dive saying Nasdaq isn't just a ticker tape.
And I think the evidence supports that. This report shows a company that has successfully crossed the chasm. They are a platform. They have the one Nasdaq strategy.
Right.
They sell a bank the data, then sell them the software to trade, then sell them the AI to check for compliance, and then list their stock.
It's a walled garden, but for the global financial industry.
In a way, yes. A faster, more automated 235 walled garden.
So what does this mean for you, the listener? Why should you care if Nasdaq uses agentic AI?
It signals that the financial world you interact with is about to speed up. We're moving toward a near 247 financial cycle, automated by AI agents that are watching every transaction. It means the market is becoming more efficient, but also, perhaps, more relentless.
It's a fascinating, slightly exhausting thought. The money never sleeps, and soon, neither will the exchange.
And here's a provocative thought to leave you with. If Nasdaq succeeds in launching 23/5 trading, and if assets become tokenized so they move instantly, does the concept of a market day even exist anymore? We rely on the closing bell to tell us the day is done, here's what the market did. But if the market never truly closes, do we lose the ability to pause, reflect, and breathe? Or does the algorithm just keep running?
Something to mull over next time you see that closing bell ring on TV. It might soon be a relic of the past, like a rotary phone. Thanks for listening to The Deep Dive. We'll catch you next time.